In this video, I'd like to look at the euro-yen trading pair, the relationship between the dollar, euro, and Japanese yen, and its impact on trading pairs. Also at the end is an overview of trading the euro-yen pair. Let's start from the beginning. Let's start with the various factors that influence currency flows. US dollar versus Japanese yen. What factors influence them? Let's make a comparison. Different flow drivers. USD versus JPY, euro dollar is heavily influenced by Federal Reserve policy, US inflation, NFP, bond yields, dollar index positioning. When US data creates instability, euro dollar often becomes noisy and choppy. Euro yen, however, reacts more directly to global risk sentiment and capital flows related to the yen. Yen equals risk sentiment accelerator. The Japanese yen is a traditional funding currency. In risk on, yen weakens to euro, yen rallies strongly. In risk off, yen strengthens to euro, yen drops aggressively. During instability in euro dollar, global risk flows may still be very clear, which makes euro yen trend cleaner and faster. For your understanding, let's define what risk on and risk off are. What is risk on / risk off? These are modes of global capital behavior. Risk on. Investors are willing to take risks. Money flows into profitable and volatile assets. Risk off. Investors avoid risk. Money flows into safe assets. Let's look at cross-pair mechanics, arbitrage effect, euro. Yen smooth, euro dollar on dollar yen. If dollar yen starts moving strongly, often due to yield shifts or expectations around the Bank of Japan, even if euro dollar is ranging, euro yen can accelerate via arbitrage flows. Sometimes dollar yen becomes the engine, while euro dollar remains neutral. What can be said in relation to liquidity structure? Euro dollar is the most liquid FX pair globally. Euro yen is less liquid arrow, easier to push. During unstable conditions, large players may generate clearer displacement in crosses rather than in the primary major. What influence do banks have? Let's look at banks and their monetary policy divergence. If the European Central Bank is relatively hawkish while the Bank of Japan remains accommodative, euro-yen structurally trends better than euro dollar. Now let's summarize briefly what I've said. Summarize. When euro dollar becomes unstable due to dollar-driven noise, euro-yen often shows stronger, cleaner FX activity because yen flows reflect global risk positioning. Cross mechanics amplify movement. Liquidity is thinner. Policy divergence can support directional bias. Next, let's look at some notes regarding the euro and the yen. Notes: euro and yen. The best SMTs are for the pound and yen trading pair. Other notes. First, correlation with risk on / risk off. Second, structural behavior in intraday trading. Third, impact when JPY is the driver. Fourth, impact when EUR is unstable. Now let's move on to today's trade on the euro and yen pair. Let's begin. Trade euro and yen. February 16th, 2026, London kill zone. Target 2RR. Let's look at the daily chart. The first thing you can see is the seizure of liquidity by sellers and a price reversal. Next, we have SMT with the pound and yen at highs. There are also two daily FVGs, one of which is in the premium zone, which creates a key level marker for it, where the price must reach in order to get a reaction to a further fall. Hourly chart, we also see the capture of liquidity on the seller's side, SSL, and also SMT, pound and yen. The liquidity pool that attracts the price, the first is the previous day's high. The second is the first daily FVG. Looking at the HTF, we already understand that there is a magnet for the price. Short positions will be irrelevant in such price action. 5-minute chart, we clearly see that the price is capturing liquidity along the way to the previous day's high. At the last liquidity capture, we have an SMT formed with the pound and yen. And an order block is created to which the price receives a reaction. In this case, I used a market order because liquidity from below was collected along the price growth path. SMT and an order block were formed with an obvious liquidity pool in the form of the previous day's high. The stop loss was located behind the liquidity rate level, and SMT, the target, as always, is 2RR, Y2RR. As I always say, in most cases, the price passes this value. Thank you for watching this video.